Miss you guys.
See, I didn't even get I know I love you.
I love you. Love you all. Hi, Michael.
I just love the first, 10 minutes of the conversation where everybody just comes together and they talk about everything but real estate. I mean, and this is the first time that New Yorkers have all come together and talked about New York's favorite sport. I know football, we have football teams and we have baseball teams, but basketball unites New Yorkers like nothing else.
If only we could win a championship.
Hey, the only New York team made it into the playoffs in the NFL this year.
Right.
Actually, that's not true.
Buffalo's the only New York team.
Yeah, well, being that there's like 8 NFL teams that are closer to where I live than Buffalo, I don't really think of it.
Yeah, but the Giants and Jets are not. They're jeans teams now.
No, they're incorporated in New York.
Incorporated in New York. Well, technically we are too. We're incorporated in New York. We're just renting space. So,
Sorry, John.
Right. It's 4:04. We should start the show. Boroughs and Burbs, number 13. And we have Eugene Cordano in the house. He is my New Jersey expert.
I'm in the blue corner.
I don't know anything about New Jersey, so I'm very excited to have Eugene. And Greg Heym, who's the chief economist for Terra Holdings, Brown Harris Stevens, and an expert on the New York real estate market. And we're going to have a great conversation because it's already getting good. So, hello, Eugene. Should I call you Gene or Eugene?
Gene.
All right. Hello, Gene. Hello, Greg. Why don't you tell us a little bit about yourselves?
Greg, you go first. Beauty before age.
Wow, that's true. I'm glad you're that perceptive. As John said, I'm Greg. I'm the chief economist of Brown Harris Stevens' parent company, Terra Holdings. Been there for 17 plus years now. Before that, I was a chief economist at the Real Estate Board of New York for 8 years. And before that, an economist at the Bureau of Labor Statistics. Just like my buddy Gene, I am a St. John's graduate. I also have an MBA from Hofstra University. Funny, the 2 schools I went to both changed their nicknames immediately after I left to be more politically correct. So I won't go to any more schools so they can hold on to their mascots. Gene?
Well, I don't know how I can top that actually, because that's I didn't even know who my mascot was. No. I've been with Halstead since 1997. Came in as a broker. Before then, I did a lot of work with REITs and conversions and things like that. And, I'm just a guy who loves real estate. And came to New Jersey in 2005, starting to do new development. And then in 2008, we opened our first office out here. And here we are. It's a brave new world. It's 2021. And New Jersey's on the radar. And I would say, I know the Connecticut people on the call are going to love what I'm going to say right now. Please write it down. The suburbs are back, better than ever, and here to stay. That's all I can say.
All right. So one of the things that I need to be oriented. So I'm going to share the screen now, and I'm going to put up a map of the area. Can you all see a map of the tri-state area there?
Yes.
Yes.
All right. So what struck me first, so I had to zoom out so that I could see Connecticut up there in the right-hand corner and New Jersey. What struck me is that there's only, you're in the Hoboken office right there, and the only other office you operate is in Montclair, and out of 2 offices, you handle the entire luxury market. Is that right?
Well, I would say 95% of it, my friend. 95% of it, yes. Yeah, we do.
Does that mean the rest of New Jersey?
A lot of territory, John.
Well, does that mean the rest of New Jersey does not matter? It's really the Hoboken next to New York, and then Montclair for some other reason, or can you handle all of New Jersey from those 2 locations?
We're in 8 MLSs right now. So yes, we can handle a very good portion of it. We don't go all the way south to say Atlantic City or Cape May, but we do a good portion of Bergen County. We do the southern end over here to Princeton. and you'll see Marlborough and Red Bank down here at which is the beginning of the Jersey source. So we cover a big swath of territory out of there.
Let me just tell you that Tammy Fellenstein, she's probably sitting, I don't know, 4 miles from me. I don't go into Tammy's territory without a written invitation, and she doesn't come into mine. We are very, very segmented in the Connecticut market. It doesn't sound like that's the case in New Jersey.
John, you have an open invitation.
Thank you. Love you, Tammy.
Love you too.
John, do you mean you're more territorial?
Well, you tell me. I mean, Eugene, are you territorial? Yeah, and Meredith, are we?
Pretty much.
We aren't. You know, New Jersey is the thing about Jersey is that there are separate MLSs. The reason why I mentioned that we're in 7 or 8 MLSs is because it's all regional. So you guys you don't know how lucky you are in Connecticut that you have CMLS rather, sorry. And, you know, so there's an MLS for Essex County, there's an MLS for Hudson County. So it gets expensive, but you can travel around. When we came in 2008, we were fending leads from, you know, probably 30–40% of our business was coming out of Manhattan and Brooklyn. And those people were far flung. So we wound up recruiting agents who would travel. And that's how we got our feet wet in all of these territories. So, you know, it's not easy to do that. I certainly don't do it myself, but there are agents who are go-getters. And, you know, coming, you know, 2008, 2009, you had to be willing to be a go-getter and travel, or you just didn't get any business. And so those people, you know, wound up staying with us.
Gene, can you give us just a general kind of lay of the land? Like if I asked John about Connecticut, he would say, you know, Darien is this, you know, this is that, this is a feel of this. Like what, I'm looking at Hudson County, Union, Essex, like I wouldn't be able to tell you the difference of any of them. Like, can you just give me a sense of like, if someone's coming, say, listen, you know, I think that, you know, people are telling me I should consider New Jersey. Like, where do you start? Right.
I appreciate that. That's a great question. So if you look at the map, you can see Hoboken is really a stone's throw from New York, you know, 5–6 minutes in the PATH train, if anyone's still actually taking the trains these days. So you have what we call the Gold Coast of New Jersey. And the Gold Coast of New Jersey runs basically from where the Statue of Liberty is all the way up through Hoboken. And we're on the right side where you see Manhattan. That's probably the edge of it. The bridge there is the GW Bridge. And so between Hoboken and the GW Bridge is what's called the Gold Coast, because we used to say that you've got a view of Manhattan that you can't buy for any price inside Manhattan from this eastern side of New Jersey. So it's all urban there. There's a real diversity of population there. Hoboken and Jersey City have actually been referred to as the 6th borough of New York City. So it's really a commuter location. And the farther west you get out is where you get into where really the demand is right now, where there's homes and backyards and pools and that sort of stuff. So if you go a little farther west, if you look at 78, Route 78, if you travel that along and go west through New Jersey, those are, Robert, Union County comes right after that. Essex County is Newark, but then goes into Montclair. And then farther out becomes Somerset County and Warren County, which goes to be 45 minutes to an hour from, say, the Holland Tunnel. Let's make that our line of demarcation. So from the Holland Tunnel west, you know, 45 minutes to an hour. Inside Union and Essex County, you've got these great suburbs like Summit and Short Hills and Montclair and Glen Ridge. And these are towns where you can sell your New York apartment, you know, for let's say $1 million, and, you know, buy a very nice 4-bedroom house and have leftover money with a nice backyard and a couple of garages and that kind of thing. And that's what's been really driving the demand in New Jersey, driving the demand to the point where, you know, our year-over-year stats, I pulled stats just for the Essex County towns, and, you know, it's 116% is the average sold price now in the town of Montclair. So 16% over ask for 2021, for 2020 rather.
How's that compared to you, John?
It's frenetic. We don't have any properties. Everything that comes on the market just sells. And the nice thing about it is it almost doesn't matter what the price is unless you're in the upper brackets, you know, 2.5, 3 million, 3.5. Those are slower.
So I expanded the map. I would say that people are willing to go an hour to say Darien on the train. And now, because of the pandemic, they're willing to go out as far as maybe Fairfield, much more willing to go further out to Fairfield. Is the same thing true with what you just said? They're now willing to go out to, I think you said Summit, which is what?
Well, you're
Clinton?
hovering, yeah, so wait, if you're right, so Summit's a little further to the right, it's a little closer. Summit is close, but so if you look, you have Basking Ridge and Bedminster. I live out in Bedminster, Far Hills. So Basking Ridge was a town that from 2008 had never really recovered, where I have a friend who lives on a beautiful cul-de-sac, paid 1.4 million for his 5-bedroom colonial, and has the pool and did the backyard. So he's into the house for about 1.8. His neighbor across the street finally sold his similar house, a few months ago in the real rush of it for about 1.8. So that market has come back. Towns like Basking Ridge pre-pandemic had probably 19 to 20 months of supply in the hopper. They were still very slow and really not in demand. These are big houses, let's say 5,000, 6,000 square foot houses, and they just were not moving. And now, they're in the bidding war scenario. You can't keep a house on the market.
What are the taxes like on those houses?
So Basking Ridge, Bedminster is cheaper than our primary towns in Hudson County and Essex County. Basking Ridge, so you figure 1.4, those taxes are around 30, 35,000. I mean, they're not cheap. Jersey is not cheap, but that's a lot cheaper than, say, Montclair at that price point, where you would be looking, if you were at 1.4, 1.5, you could be looking at 45 and 50K a year in real estate taxes.
So I want to switch gears over to Greg now and say, I've been reading your, is it twice a week blog, The Line, Greg?
Correct.
And it's the blog that The Real Deal says my email box is missing. So The Real Deal is a big fan of The Line.
Why wouldn't they be? I mean, everybody loves it. Come on. Why are you so late to the party, John?
It is a lot of fun.
Travel up north so quickly.
So if you're a regular reader of The Line, you are always talking about jobless rates, you're talking about inflation rates, you're talking about the drivers on our real estate market. So given what we just heard, that Basking Ridge and Bedminster are looking good, people are buying out there, what do you think the biggest influencers are on Bedminster, Basking Ridge, and frankly, Darien and Westport, this year?
Well, a lack of density and the virus, for one thing. Obviously, people looking to get away from high-rise buildings and public transportation, and building personnel and elevators have flocked not just to those areas, but the outer boroughs of New York City as well. People forget that a lot of people leaving Manhattan are going to one of the other 4 boroughs. They're not necessarily going to Connecticut or New Jersey or Long Island, where I live. So I'm a suburban guy too, John. So don't lump me in with those city folk. But I mean, that's certainly a huge part of it. There are also, I mean, you're not doing it for the taxes. I mean, that's the main reason people have been leaving the last couple of years. But those people are going to Florida and Texas and other southern lower tax or no tax states. So I think that also the working remotely has had a big influence on people willing to think about places that they'd never would have considered commuting from. I mean, we've had this 10-month experiment in remote work that has really proven that the vast majority of us can work from anywhere. And I think that's what's, like Gene said, expanded people's boundaries as to how far out from their office they're willing to live, knowing that even when the pandemic is under control, people will probably still retain some degree of remote working, because I think most people enjoy it some of the time anyway.
So that's the key question that Gene wants to know. I want to know. Everybody out here in the burbs wants to know is, you just said that the biggest driver was the pandemic. And we want to know, is this short-lived? Because we're seeing sustained demand, and yet the top of the news every day is the vaccine rollout, and that we're looking at the end of the tunnel. The election is behind us, and
Look at it
everybody's
this way.
optimistic.
That part of it also is there was a pent-up demand for housing. You know, existing home sales in 2020 hit their highest level in 14 years. So, you know, it's not just these suburban areas around, you know, big urban cities that is attracting all of this interest. It's the whole country. So that's part of it. The record low interest rates are part of it. You know, so I think that your market will also be helped, as will Gene's, by the recovery of New York City's economy, because you rely on that, maybe even more than Gene does, particularly the finance sector.
Wait, why do you say that?
Well,
Why am I more reliant than Gene?
I think you need a very healthy finance sector to keep demand for a lot of the towns in Fairfield, Lower Fairfield County, you know, strong. You do draw a lot of interest from Wall Street and hedge funders and those types. So I think it will benefit everybody. As I said the last time I think I was on your show, some of this exodus will be temporary. You know, people, it's a flight from, you know, a once in 100-year pandemic that obviously has a lot of people scared. You know, some people may have said, you know, this is the last straw and I'm leaving. You know, there's been a lot of change in New York City that hasn't been good recently, but I think we'll get better. I mean, you know, there's been unrest, obviously, a deterioration of services, and that's a concern when you have budget gaps like the city and every state basically does. But I think there's the light at the end of the tunnel. See, John, the great thing is there are two things that are going to help all three of us. Well, maybe three things. So we should all be rooting for the same three things. One of them is New York City's economic recovery, which is lagging the nation's, but that's expected. Indoor dining is still closed in New York City, as are, you know, many of the things that draw people to the city: theater, sporting events, things like that. So that's number one. Number two is a potential for an increase or a repeal of the SALT cap. Obviously, with the Democrats in control of everything now, it certainly increases the probability that either that $10,000 gets doubled or raised even higher than that, or gets eliminated. It's still a risky proposition, even though, you know, the Democrats can pretty much do it if they want. There is some resistance within the party. So we'll see. But I think even worst case scenario, that cap will get raised. That will help everybody. You know, I think for you guys, property taxes, you know, Gene's mentioning, you're talking about $30,000 in property taxes being cheap when you think you can only deduct 10 of those, you know, not even including your state income tax. So I think that will help. And a third thing would be, you know, the possibility for real state and local aid. You know, that hasn't been a part of a stimulus yet. President Biden's proposal is $1.9 trillion stimulus, has state and local aid. And I think it'll be important for all of our areas, but I think New York City may be most important because the MTA is so broke right now. It desperately needs money. I do not miss the Long Island Railroad at all, I can tell you that. But getting the aid that they need will enable them to keep services running, but more importantly, hopefully, will get rid of the desire to increase taxes. And, you know, we have a very progressive legislature and governor up in Albany, and City Hall is very progressive. And obviously, both New Jersey and Connecticut are run by the Democratic Party. I think, you know, it's very dangerous to raise taxes further. You know, Governor Cuomo has now said he's going to hike taxes $2 billion if he doesn't get any aid. And he's actually even threatened to sue President Biden if he doesn't get aid. But, you know,
and yet, New Jersey's in an election year.
Right.
So they probably won't raise taxes this year, at least they're not posturing. And Connecticut's governor has already responded to some of the bills in the last 48 hours saying, I don't want to Senator Looney, I don't want to raise taxes. So if Lamont doesn't raise taxes and New Jersey doesn't raise taxes, will Cuomo raise taxes unilaterally?
Well, part of the problem is that the Democrats now have a veto-proof majority in the state Senate. So, you know, if he needs to get a budget done and New York State's fiscal year ends at the end of March, he may have to cut a deal. But they will tell you it depends on the amount of aid they get. If they get the aid they need, the governor said he really doesn't want to raise taxes because he's smart enough to know that the wealthy are already leaving. You know,
John, I thought the proposal in Connecticut was to raise the tax.
What's that?
I thought the proposal in Connecticut was to raise the tax. Was that a mansion tax or was that something different?
No, there are a couple proposals. All of the hundreds of proposals came out from the legislature in the last 48 hours, and a few more hundred will get made. And Senator Looney said, "I'd like to institute a statewide property tax in Connecticut." And the governor's response was, "I don't want to raise any taxes."
Okay.
Well, that's the
But
fundamental.
the problem with Senator Looney's proposal is that it would have unfairly penalized Fairfield County because they were basing it on an assessed value of 300,000, which if you elevate up is a market value of 430. And basically in Darien, Westport, Greenwich, New Canaan, 95 to 97% of all houses sell for more than 430,000, but that's not true in the rest of Connecticut.
So John, I heard on NPR today that the proposed tax that would be based on a assessed value of $400,000 would raise somebody's property tax $30 a month. $30 a month would be $1 a day. Okay, instead of buying a venti coffee, buy a mid-sized coffee. Okay, the salt tax is a myth. The salt tax is a myth because with the alternative minimum tax, nobody got the deduction for state and local taxes. And most of our buyers were not subject to the salt limitation. They thought they were because when their accountants asked for the information, they asked for that information. They never got the deduction. So a lot of this, and like usually, there's a lot of noise and chatter and less facts, that the politicians talk about. Right. So it was very beneficial for Lamont to come out against the tax at $30 a month. Let's talk fact. What are we really talking about?
Tax hikes, hike, Michael. And one thing I think is these three states all have one thing in common, right? They have the highest taxes basically in the nation, or among the highest. And New York City, Cuomo's proposal for raising taxes will make New York City's top rate the highest combined rate in America, right?
Right.
So, and it doesn't matter if it's $30 a month more than the next city, it's the highest. And I think it's like the mansion tax, or any other tax. Like
the pied-à-terre tax, right?
Right. New York is about to try to shoot itself in the foot and other parts of its body by Senator Hoylman's pushing this stupid pied-à-terre tax that will barely raise $100 million and will cost them over $400 million in lost taxes because luxury buildings aren't going to be built. The billions of dollars these people spend will go away. And then you'll get more people flocking to the suburbs, John and Gene. You'll love it. You just open your arms and say, we don't have that stupid tax here. Please come. We'd love to have you. And by the way, one of the things you keep hearing is, people can work from anywhere now. They don't have to be in the city. Well, guess what? Rich people can live anywhere in the world they want. Right. They don't have to be anywhere. Right. So, this is the dumbest idea, and they're not doing it to raise revenue necessarily. It's been around for 6 years. But, I think that the senators that we've spoken to are starting to realize how devastating, because you can levy all these taxes on rich people. They're not the ones that get hurt by it. If you levy a pied-à-terre tax and the pied-à-terre owners, notice I didn't say rich oligarchs because those aren't the people that are going to potentially pay this tax. They're going to leave. Demand for these apartments is going to go down, so fewer of them are going to be built. So construction workers will lose their job, building service workers will lose their jobs, waitresses, waiters, all the people that service these terrible human beings whose only desire is they don't want to live full time in their apartment. If I hear one more stupid article about, I walk down 57th Street and all the lights are out, give me a break. These people are paying a fortune in property taxes, sales taxes. they pay income tax if they earned income here. They're not immune from it, you know. And as
I got a question. I've heard,
the lights aren't on.
I think I've heard two different things. The first thing I heard was the pandemic is the biggest influencer on our real estate markets. And I heard that real estate, the tax policy was a rather minor driver. And now I'm hearing that some of these proposals, the pied-à-terre tax in Manhattan, the property tax in Connecticut, some of these proposals have an outsized influence on the real estate market. Is that true?
Of course, because we're all competing, right? We're all part of the same happy family, but all our markets are competing for buyers. I mean, let's face it. And I think that obviously our three states being as high taxed as they are, people are willing to pay more. You know, where I live in Long Island, I think we're only second to Westchester in terms of property taxes, you know, how expensive they are.
Yeah, but why are people willing to pay more? Because they need access to Manhattan, right?
Right, and
so if Manhattan doesn't ever come back, to your first point, we're all in trouble, right?
It will come back.
It's coming back.
It will come back. I mean,
that's going to come back.
That's a given.
I know you are. Listen, we need you to, right? Because to Greg's point, why does anybody stay here to pay these taxes and to pay the cost of living that we have to endure? And all the other things and the traffic and whatever, right? Traffic's not so much of a thing right now. If there isn't some reason to do so. Otherwise, we all pick up and move to greener pastures and, you know, wear flip-flops all day long.
Now, that'd be great. That'd be awesome.
Greg,
you know, if I may,
Greg, I
close Michael's point. One, you talk about SALT tax, right? And Michael is 100% right. And he and I and Greg have had these conversations for years now about SALT tax. Let me tell you how SALT tax affected a particular market in New Jersey. This will be quick. There's a town called Bloomfield. It sits between, it's right next to Montclair, basically, right? It's what we might call, I guess, a working class town or blue collar town, right? If we can even say that anymore, right? But it's not a very expensive town. And it's a town that really, the most expensive houses there were maybe $700,000, right? SALT was eliminated. Michael's point, AMT came in. You had buyers now, houses in Bloomfield that were $300,000 and $350,000, for example, had taxes between, I don't know, $8,000 and $10,000 at the time of 2017 when they passed the Tax Reform Act. Those houses were snatched up like there was no tomorrow by local buyers getting in there. And what was happening was the pricing on them was going up really exponentially year over year. So you went from a $350,000 3-bedroom modest home. That same home in 2019 was now a $500,000 home with $12,000 in taxes or $13,000 in taxes. So I say that all of these policies, if you talk about taxes and what Greg was saying about how the people who get hurt by this are not actually the wealthy people. You know, to Michael's
they're not
point,
the Manhattan buy.
Right, exactly. To Michael's point, our average price point in New Jersey is $900,000, let's say. Those people are not affected by a SALT tax deduction. And the truth of it, as Michael will tell you, is before they changed that, you couldn't get the entirety of your real estate taxes deducted because it was weighted on what your income was. So if your income was 500 or 400 or whatever it was, you weren't getting the full benefit of those real estate taxes anyway.
But I think it's the notion of it. It's
sentiment. I agree.
And I think people didn't bother to figure it out.
People, right, exactly.
Absolutely. It is a misunderstanding. And where you're right and where you're so right, Greg, is that when the pied-à-terre tax was proposed, you're the one who really fought it in Albany. Okay, let's let everybody, you know, Wrigley is the one who fought it in Albany. And you pointed out that, you know, they said they were going to raise like $500 million or whatever.
$750 million.
$750 million. And you showed them where they were going to actually raise $100 million. So it's what I said earlier. I said it's the noise and the chatter. It's the misunderstanding. Okay, it's like the talk about in Connecticut about the raise in the property tax. Okay, and it sounds good that Ned Lamont came out and said, no, I don't want to raise taxes. And if anybody understood that he said, no, that I don't want to raise your taxes $30 a month, they'd say to him, thank you so very much.
But
you know,
remember the climate, though.
It is really the sales, it's really the marketing and the sales behind it, as opposed to the reality of it.
It's a political thing too. You know, Brad Holman is very well aware of, the fact that his tax is going to devastate the city and actually cost them money, this pied-à-terre tax. He doesn't care. He's running for Manhattan Borough President. He wants to be mayor. The New York State Legislature, when they made rent regulations permanent a couple of years ago, knew it was going to lead to dilapidated buildings that broke down because landlords can't afford to fix them because they can never raise the rents and they can't recapture any of the investment. They don't care. They're catering to the 70% of New York City residents that rent. And I think that's everything is, in case everybody hasn't noticed, becomes so much more political than it's ever been. That, but my point is the budget gaps that every state and local government has right now, they have to be very careful how they're closed, because you have a region where there's transportation into Manhattan from Long Island, Connecticut, New Jersey, very easy ways to get in. You have to be careful. If you push it and you continue to raise these taxes, which are already, very high, there's a consequence, and you're exasperating something that's already begun. And I say all the time, I think a lot of the people that have left for the pandemic reason will come back because they'll realize why they moved to Manhattan in the first place. It's no knock to Connecticut, New Jersey. They just realize, I like walking to work. I like mass transit. I like, everything the city has to offer. All that stuff is open right now. So I think, we've seen flight from,
Go ahead.
By a robot. I think that we saw flight in the 70s when the city was really in decay and when crime spiked in the 80s.
What happened?
And you certainly see it, after.
All right, I'm going to unmute you individually now. Go ahead.
Oh, yeah, I can see the things coming on. So I think that, we've seen it with 9/11. We've seen it with even Hurricane Sandy. People will leave and then they'll realize that, wow, I actually missed the city. And we thought companies were going to keep leaving the city, especially after we screwed over Amazon, and basically reneged on a deal that the governor and the mayor had made. So, and Amazon actually thanked us by bringing more jobs here, not the same jobs, but at least they're still coming, and the tech firms. So the benefit from the pandemic will go away for the areas that people have sort of fled to a large degree, but that doesn't mean your markets are going to turn around and go south. The fact is, the economy is doing really well. GDP came in at 4% annual growth in the fourth quarter. That's pretty good considering the federal stimulus ran out in July. And I think that's, we have almost a record number of savings. People are sitting, Wall Street Journal reported yesterday, on $1.3 trillion through the first 9 months of last year. Savings rates never been higher. Consumer sentiment towards buying a home is very, very high. Most people expect to buy a home this year, or a much higher percentage of people. So I think there's a lot going for all the markets. And we're going to see slower growth in the first quarter for sure, but all across the United States, because you have to remember that with the increased restrictions, we saw December was the first month we lost jobs since April. We've seen initial claims remaining elevated. We haven't had, the puny stimulus checks have gone out, but that's not, as big a push as I think we should have. But if President Biden's proposal, happens and we send bigger checks to people, there will be a lot of money out there. And I think rates are going to stay low. The Fed has said they're committed to that. So John, we can all benefit and be happy.
So Greg, I always bring up inflation and you say to forget about that.
Yes.
I understand that. And I know that the Phillips curve, you've thrown that out the window.
This is the Kool-Aid. Drink the Kool-Aid, Roberto.
You've taken the Phillips curve and you've thrown it out.
Right,
But
yeah.
with so much stimulus, are interest rates and inflation not bound to trend up?
Well, and it's going to tick up as economic growth, accelerates over the long term. I mean, we had 33% growth in the third quarter, but that wasn't sustained, and obviously didn't go on long enough. But just think of it this way, more over a decade ago, in the wake of Lehman Brothers, we printed trillions of dollars. We kept rates at zero, I think the thing to remember is, and Milton Friedman, I think, was the one who really drove us. So I'm sorry to sound like an economics professor, but inflation is a monetary phenomenon. It's too many people, too much money chasing too few goods, right? And I think you have to look at the money supply and see how fast it's growing as part of it. And, to get to the Phillips curve, that for those of you who forgot or hopefully never learned this thing, it basically talks about the relationship with unemployment and inflation. And at a certain level of unemployment, you'll have to have inflation. But look at the recovery that we had before this happened. It was the longest recovery in US history, in terms of how many months the growth went on. And still no inflation, an unemployment rate that's at a record low, still no inflation. Interest rates were kept low for all that time, still, no inflation. I'm not saying it's dead and buried, but Roberto, when was the last time inflation was a real problem in the United States? Don't answer because you can't remember. Michael was probably in college at the time. That's how long ago that was. And, a lot of, when I speak at sales meetings, a lot of brokers go, I remember 18% mortgage rates. Yeah, it was in the early 1980s. You had to have a recession to break the back of inflation. But, we're a service-based economy now. We don't ramp up hiring like we used to. In a manufacturing economy, when the recession happens, you lay off everybody at the Ford plant, then things improve. You hire them all back. Things move quickly. You see companies now are a lot more conservative about that. They just make us all work a lot harder, which, by the way, I enjoy a lot. So that's.
And what about capital gains?
Well, one of the things that's concerning, I was, that could hurt all three of our states here is, President Biden is proposing a lot of tax hikes on the wealthy. He wants to hike income taxes, which would be bad for us as high tax states, because, then it's not even a SALT deduction issue. If my taxes, at the end of the day, taxes are taxes. Who you're paying them to doesn't matter. You don't like paying them. So that could drive people away from the region, which would be concerning. Taxing capital gains rates at certain income points as income, as regular income and not at capital gains, is problematic, and this is something that Democrats have talked about for a while. Why is it taxed at this puny 20%? Well, because, a lot of people forget that that's a risk you take when you invest. That's not a guaranteed rate of return. So you've got to look at both ends of it. I understand that the governments at all levels need money. Looking at the rich is the easiest way to close gaps. They're paying the most in taxes. And I think it's probably, who knows if it's going to happen. Remember, some of the biggest backers of the Democratic Party are Wall Street. So they're not going to like that Wall Street doesn't want change any more than my parents do, right? They don't want rates to change. They don't want regulations to change. They like everything where it is right now. And I think, with this talk looming, I mean, New York State's talking about a stock transfer tax. You want to talk about a stupid idea? It's like, let's drive every training firm out.
All right, Scott, you had a question.
I mean, when you look toward some of the damaging things that are happening, I think governance is a huge part of it. And again, talking about just like, $30 a month doesn't particularly matter, but it's just another thumb in the eye. I think one of the more dangerous things that's out there is the possible tax on financial transactions.
Right.
Is there any possibility that goes through? And if it does, what would that do for our area?
It'd be terrible. I mean, a stock transfer tax is ridiculous because, again, we can't all agree that people can work pretty much anywhere now and think that people are going to stay and pay higher fees and lower their profit margins. It doesn't make any sense at all. I mean, New York City is dumb enough to still tax commercial rent. Can you imagine that? I mean, your office tenants are leaving And it's like, well, we still, in some parts of Manhattan, you pay a tax on the rent you're paying for your office space. I mean, and I think that these areas have to look at this stuff. It's very easy to say, well, that's a tax on rich people. The pied-à-terre tax is a tax on rich people. The millionaires tax is a tax on millionaires. You know, it's very easy to say that, but again, who gets harmed by this stuff? It's the people that remain when those people leave.
Because
And
they don't have the options to leave, right? Who are they hurting? They're supposedly hurting all the people that they claim to protect.
And property values go down for everybody.
All right,
Then,
who's leaving New Jersey and why are they leaving?
So I would say the majority of people leaving New Jersey are, empty nesters. And maybe let's say if the demographic is 50s, right? Their kids graduate high school, they don't need to be in the schools or pay the taxes anymore, and they don't have to be in Manhattan. Or they can come back, once a month or whatever it is. And where are they going? Most of our outbound relocations are going to South Carolina, Florida, Tennessee, Texas. Low tax is in there, but not always, but they are definitely going south. Most of the people are going south for warmer climate. And I think taxes drives that, but for some, maybe not.
Do you have some coming to Manhattan?
Few, very few. We used to have a decent business of empty nesters coming from large suburban homes, buying, 55 and overs or pied-à-terres in New York. That has pretty much dried up. I wouldn't say the pandemic necessarily had anything to do with that. It was slowing for the past couple of years.
well, by the way, I don't know if I put this in the line. No, I don't think I did. According to U-Haul, do you know the #1 state for inbound migration last year based on one-way rentals?
No.
Florida, Texas?
Florida's #2. It's always in the top 3. It was Tennessee.
They're leaving Tennessee and coming here?
No, going
to
inbound to Tennessee.
Okay.
It's the #1 state people are moving to, at least based on U-Haul data. I mean, if you were going to move to Los Angeles or New York, I don't know if you'd hire a U-Haul, necessarily. But, I think that, with the older people, obviously that had been helpful for New York City, that people were staying later in life too, that people weren't going to Florida as early as they used to. But with COVID, that's hurt it both ways, But I agree with Gene that it wasn't a huge source of people coming to New York. It was more people staying much longer than they normally did, which really exploded the healthcare industry in New York City.
All right. I have a question for both of you. I don't know who wants to tackle it first, maybe Gene, but we are here. You've already said that Connecticut is disproportionately dependent on Wall Street and the financial sector. I agree with you on that. And therefore it leaves that New Jersey has probably got more tech workers, manufacturing, high tech. I know Sony and a lot of the others have their headquarters there. So it occurs to me, is New Jersey, Gene, or Greg, is New Jersey currently, or will they be a beneficiary of the tech growth in the city? We're hearing about Facebook, Amazon, Google, all getting each, I think, 1 million square feet of space on the west side of Manhattan. Are we seeing that as propping up the Manhattan real estate market over the next year? Or are some of those people finding their way out to Basking Ridge?
So I think actually that a lot of those people are finding their way to Hoboken and Jersey City, looking for a cheaper alternative, but New York similar lifestyle, high rise, walkable, gym, pool, that kind of a thing. Only the execs, I think, with families would go out to the burbs and to the houses. We're currently working, I can't give you the company names, we are working with 2 large technology companies through relocation to place 30, 40 people that are, middle management to upper management. And they are both tech companies. So I think we are benefiting from it. I think the interesting nuance about New Jersey is when we came to New Jersey in 2005, all the developers the national developers couldn't wrap their heads around why people would not want to come to New Jersey and live, because we're close to Manhattan, we have views of Manhattan, we're cheaper, you have more bang for your buck, right? You get more square footage for your dollar and that kind of stuff. People's affinity to New Jersey became something where they were either not comfortable or didn't want to pay for Manhattan, right? Or they had some sort of familial tie to New Jersey, which made them stay in New Jersey, and they were close enough to Manhattan. And those were the two drivers that drove apartments for many, many, many years in New Jersey. Now, and Greg and Roberta, you can now apartments in Manhattan. There are apartments in Manhattan at 20-25% less than they used to be that are cheaper than living in a high rise in Hoboken. I mean, it's insane. So the apple cart is really been turned upside down.
Are Hoboken values sustainable when Hoboken is more expensive than Manhattan?
I mean, you know, Hoboken right now actually did pretty well year over year. I mean, I can show you some stats if anybody wants to see it. It had a slight increase in valuation. Hoboken is actually probably one of the better marketplaces of any of the marketplaces that you could be in, because it's small, there's a limited supply, and property values do hold up. You don't see that in other parts of town like Jersey City. In Jersey City, there's thousands of high-rise apartments that are cookie cutter, right? They're all effectively thrown into the same batch, and that may not be fair to them, but it is what it is. So in Jersey City, you do have dropping prices. So you know, it's not apples to apples, even though the towns are literally next door to one another, and you sneeze and you're in another town. But there are some intrinsic values to some of these towns. And New Jersey, I guess, much like Connecticut, is very town centric. If you're on a train line or you're on that 78 corridor, or if you're going north, if you're in that Bergen County corridor, Route 17, these are like the prime in-demand suburban towns, and they do hold their own.
Because they're easy to commute to?
They're easier to commute to, yes.
Is that one of your advantages over Long Island? I got a question in the chat window about what about Long Island? How do you sell against Long Island and Connecticut? Easier to commute to?
I mean, I have to say, I don't think we actually compete that much against Long Island. And I do think the Connecticut sell, to your point, John, is yes, easier commute.
That's because you know better.
Cheaper, possibly a little cheaper. I don't know. I leave it to you. I leave it to the Connecticut team to tell me that. But I think there may be a little bit of difference. You know, I think New Jersey, even in the, I think our price points are lower than your higher end in Fairfield County. At least, you know, Tammy, I'm sure you could chime in on that.
It's your taxes are higher. That's why.
Oh, everybody's taxes are high, John. Come on. I mean, okay, getting to Long Island, because I saw someone asked, you know, Nassau and Suffolk home prices have never been higher. They're both at records right now. And, you know, if you live, I grew up, I saw it on the map before in Valley Stream. Valley Stream is right on the Queens border and still considered one of the best places to live in America because it's like a 30-minute train ride to Manhattan. So there are a lot of places in Long Island. I live in Wantaw by Jones Beach. My express train is about a 45-minute commute. So, you know, people are flocking to Long Island because they can't find what they want in Westchester. You know, Connecticut is hard to get anything because the Hamptons are having, you know, the best year they've ever seen. It's, you know, because of all the people flocking there or making their pied-à-terres full-time places. And I think it's a trend. Obviously, things are going to slow down. When you're in a growth cycle that has been going as fast as parts of this region in the country, there's a step back at some point. And I do think, you know, we're going to see that a little bit. But the one thing that's funny, Long Island's economy is not great. You know, Connecticut's economy is not great. New Jersey's economy is not great. Again, that's why you feed off New York City. And I think it's, you know, that's again where we have to root for New York City. But again, this isn't, I know John likes to make it a new, see, last time I was on, it's like New York versus Connecticut. Now we throw New Jersey in. So it's like a three-way fight.
I just want to know how, you know, how we talk about our markets. You know, do we talk about the commute? Do we talk about low taxes? Connecticut has always hung its hat on having lower taxes than Westchester. we don't really talk about New Jersey because we don't understand New Jersey. But we do talk about Fairfield County versus Westchester County because they're right next to each other. And we say for an extra 15 minutes, you could be in Greenwich paying a lot less taxes. And then
property taxes.
Yeah.
Not income taxes.
I'm a realtor. I talk about.
Okay, well, I'm just saying, if all your taxes were lower, it'd be an easier sell that way. But
so it's interesting to me how New Jersey talks about their competitive advantage, and I've heard commute, and I've heard our prices are cheaper, and I've also heard that that in Hoboken you're looking at the New York skyline, and it's exciting. It's exciting like New York, but it's and I think
is that everybody came to this region to be in New York, and Manhattan is on sale. It's a play, a drama, mind you. Some people have exited stage left, some exited stage right, but we're only in the second act, and they're all coming back.
But wait a minute, I heard New York is not on sale. I heard
it is.
New York is on sale.
When have you had a better value? More metrics line up and a better value to come to buy in Manhattan? When have you had more choice? When have you had low interest rates like they are? When can you negotiate like you can? When has the sentiment been this poor for sellers such that you can have a conversation?
And when has the stock market been this high? That's another thing too. The biggest difference between the last recession and this one is after Lehman Brothers happened, most people's portfolios were down 40%. Guess what? The stock market keeps hitting records. NASDAQ just seems to be headed to the moon. And like Roberto said, if you're looking to buy particularly anything over $1 million, it's the sale of the decade right now, maybe even more, especially if you go north of $5 million. And I think you're running out of time to get the biggest deal, because as vaccines pick up and things reopen and people return and they're back in their offices, it's too late. You've missed out. So everything has fallen in place for the people that want to trade up, the people that want to, get to their first apartment in Manhattan, or even rent. It's as good a time as anybody can remember to rent in Manhattan.
You're the economist. I heard prices are down on that $1 million place, because we were just talking about $1 million places and $500,000 places in New Jersey. That $1 million place, that market's not down at all, and the general market down what, 8%?
Well, it depends. You can't slap a number on a market. Just like all your towns. I bet you think, every one of our Connecticut brokers thinks their town is the best, right? Forget what's going on in Stamford, right? We're better here. Sorry, Tammy. But, it was just an example.
Help me out here. Put a number on what has the Manhattan.
You don't. No, I don't, because it's irresponsible. You don't. That's like you bought Apple stock and you go, well, the S&P 500 did this today. Well, then why did my stock go down? It's irresponsible, because every market, I can tell you that the fourth quarter data.
You can't say Manhattan is on sale unless you'll put a number against it.
All right, look, let's throw some numbers out there. The declines over the last year are based on one thing: inventory levels. We do a monthly inventory report where we report on the month's supply of apartments for sale. So if you look at smaller apartments, obviously there's few of those. Affordable studios are always going to be in low supply in Manhattan because they get gobbled up. But when you start looking at 15 months of supply, 20 months of supply, 30 months, the biggest damage right now has been done to the luxury co-op market. Those prices were down. The average price of 3-bedroom and larger co-ops was down over 20% year over year. So you'll see year over year declines as low as 3% and as high as 20% or more. And the problem, John, is that we don't know the extent of the decline because there's still too much inventory sitting out there. And price cuts are going to have to continue at certain parts of the market, and particularly at the east side in Midtown, where the inventory levels are highest. So you're chasing a moving target. It's hard to know where it ends. But the important thing for us is sales bottomed in the third quarter. They rebounded, nicely in the fourth quarter. Contract signs for apartments in Manhattan were up in the fourth quarter compared to a year ago. A year ago wasn't that great, but we'll take it. It's progress. And I think it's, that's what you're looking for. So to slap a number is sort of, again, it's irresponsible and it's misleading. You know, you go to a place like Upper Manhattan.
Okay.
Upper Manhattan does not have the inventory problem that the East Side does. You know, the West Side has less inventory for sale than Midtown. So they,
All right, I'll just ask Gene. Gene, how much is Basking Ridge or Bloomfield up this year? He'll tell me.
Bloomfield's probably up by about 8 or 10%.
8 or 10.
Yeah, 8 or 10. I mean, Basking Ridge probably a little less. I mean, you know, you've got Montclair is up by a good 13% this year in those, you know, Glen Ridge. These prime towns are really seeing, you know, unheard of highs in pricing and increases. We don't even have appraisal problems. The market was moving. So, you know, when a market starts to move like this, at the beginning in, you know, May or June, we were having real issues with appraisals. Now appraisals are the houses are keep going over ask, and appraisers are not appraising them lower or even below ask. They're actually giving, based on the comps, they're giving you 3 or 4% increases. So it's really quite remarkable.
Wow. Is there, Gene, let me ask you something. So the last time we spoke, Greg and John had a little argument. John said that they have coyotes, and Greg said they have sharks in Long Island, and John said these are things we don't talk about because they're bad for business. Is there anything in New Jersey that is bad for business?
Yes, the Jets. The Jets are bad for business. You know, we joked about this before, but having them even play in New Jersey creates a stink in East Rutherford. Go ahead, Gene.
Greg, let's be focused. Can we be focused? Come on.
I thought I was.
We do have. Well, I tell you, we have bears. Bears. You know, bears could be problematic. You know, so I'll just throw that out there. We have bears.
Not in Hoboken.
Hoboken has nothing. There's really the only wildlife are some very rabid squirrels, but you know, that's about it. You know.
Greg, I had a question. The last time we saw you was late October, and inventory was probably at its peak. It has really dropped off since that, but I'm anticipating that it's really going to bump. Do you anticipate the same thing or not?
No, I mean, the big unknown, because seasonality has been thrown out the window, right? You know, because people didn't put anything on last spring. They put it on in the summer before the buyers really came back. The inventory levels have come down. They're still way too high relative to the number of closings. But the big question is, you know, how much stuff is going to come on this spring? And what is that going to do to the market? And I think, you know, I think it might help to accelerate price declines. And I think there will be the momentum of the vaccines, the economy improving, you know, the potential for a change to the SALT cap, and the aid that the city needs so badly. I think all those things are working in our favor to help attract buyers back or to Manhattan for the first time. But I think worst case scenario, we get back to a number near 10,000, which is.
So you do anticipate it's going to start?
I would think it would increase because the pace of closings is picked up, but not to the extent that new listings might.
Okay.
But you know, it's not going to be across all price categories. It never is, regardless of what John thinks. We don't just sell one type of apartment here in dreary old Manhattan where you just pick which one you want. But I think that's the big concern is the inventory. If it's higher than anticipated, you know, it's going to put prices lower. But I think that will continue the momentum because buyers will have more choices.
I think we have to put specific numbers. And I had heard the high end was down 20%. I had heard the modestly high end was down 8%. And I had heard that you are not going to get a deal on a 1 bedroom, on a studio in Manhattan. That demand continues despite the pandemic for 1 bedroom and
you might get a deal depending on where it is.
Okay.
Obviously that matters a lot. But no, I mean, Manhattan, you know, one of the problems with Manhattan is we build the inventory we least need. Like, you know, the thing we need are affordable studio 1 bedroom apartments. And of course we don't build those because it's very expensive to build here. So that's the only way to make money. I know I see Michael nodding his head. He knows all about it. And that's the thing. So that's, but with the rates, and I think the job opportunities that will come, because companies are not going to abandon New York. They're just not going to do it. They may lower their footprint, but there was just this big Midtown East rezoning that allowed office building owners to really tear down their buildings and build them anew and go above what the zoning allows. And one of the companies doing that right now is JP Morgan Chase. Their headquarters now they're probably sorry they went ahead with that. But, I think they're not going to abandon. They know, they're smart enough to know they need to be here, and their people want to work here. Look, I've been working in the city for 28 years, 29 now, and lived in Long Island that whole time. I love working in the city. I love being around, walking around the city. It's like to me, I get the best of the city. And then on the weekends, I can go to the beach because I live in the South Shore of Long Island if the Sharks aren't out, The reason I mentioned the Sharks was that was the first time in my life, I'm turning 51 next month, but that was the first time in my life that I ever had to be afraid of sharks in the water in Long Island beaches. It never happened. You hear about it like parts of Jones Beach where people don't swim, but even the town beaches too had to worry about this. And so it just goes to show you're looking for the locusts to come, because how many more plagues can we face? I mean, so
it's biblical.
It is biblical. That is a good way to put it.
All right. Do we have any parting thoughts? It's 5:04. We don't have to wrap up right away. Any parting thoughts from Greg or Gene?
Go ahead, Gene. I'll let Age go first this time.
I just want to say, Greg and Gene, thank you so much for joining us. We really, really appreciate it.
Thanks for having us.
We have Steve Kligerman. So
a lot of good info. Save the hard questions for Kligerman, John, because they have the biggest challenge right now to really figure out how quickly that product can be absorbed and what's going to happen with all this shadow inventory.
So for those who don't know, Steve Kligerman is in charge of building the new buildings, new development. And last time we had him on the show with you, he said there's still a demand for new. It's just a different product. We're just building a different product, and we're building it further out, and maybe we're building it at a lower price point. So we want to catch up with Steve next week and find out how that's changed since we saw him last May.
Well, John, thanks for having me, and guys. And all I can say is come to New Jersey. If your buyers are priced out of Connecticut, I'm sure we can find something for you here. There may not be a tax benefit, but they might have a shorter commute.
With the American flag in the background, it looks like an infomercial almost. Like, hi,
would you like to buy some gold? No.
please come to New Jersey. Well, and don't forget to look, don't be afraid to look for value. And me and Roberto keep mentioning it. If you want to get the best deal, you go where there's too much supply. And I think that's clearly Manhattan right now. We don't want that. It's not like an award we're proud of, but it is a good way to get interest. And look, this region has a lot going for it, and it's supported by a great economy and, pretty good transportation. And I think that's why it's remained so healthy. And we're all going to be in a much better mood in a couple of months, I think, and really looking forward to life back to normal.
Because the Jets and Nets and Knicks are going to do well?
No, well, the Nets might, because they bought two superstars in the offseason. But the Knicks will always be pathetic because I think Jim Dolan's never going to sell the team. The Jets will always be pathetic because Woody Johnson doesn't know how to run a football team, and neither did Leon Hess before him. Think of it this way, John. The last time the Jets won the Super Bowl was the year before I was born. And I mentioned me and Gene are huge Rangers fans, and we're looking forward to the development of this team. The Rangers have won once in the last 80 years. Once in the last 80 years. It was a great year, 94, but.
And the Yanks starting pitching for the Yankees is?
Well, it's Garrett Cole, followed by Garrett Cole, followed by an opener, Look, and Tanaka is going back to Japan. That was announced today. I think the problem with the Yankees is they can't stay healthy at all. And they thank God they signed LeMahieu because he's the only one on that team that can hit for average.
He's good.
So if I'm looking for a conclusion, we're all optimistic about New York, but not because of the sports, not because of the tax policy, maybe because of the tech industry has finally discovered New York. And on that, and I'll take it. And you know what? That just might be enough. Thank you, everybody. It was a great call.
Great call. Thanks, everybody.
Thanks, John. We'll see you.
Have a great day.
Thanks, everybody.
Thanks, guys.
Thank you, everybody.